Disney shares are falling, though they've recovered a bit, down 2.5% on the back of earnings that missed Wall Street expectations across the board, including those Disney Plus subscriber growth numbers. The stock was down almost more than 5% at one time after earnings, and now has come back a little bit. The conference call is going on right now, and joining us is Jim Stewart of the New York Times. He's also a CNBC contributor, wrote a book on Disney. Jim, it's great to have you. The book on Disney, I should say. So I wanted to start with Disney Plus, and it looks like Bob Chapek, the CEO, on the earnings call, continues to repeat this idea that they are managing it for the long term and not quarter to quarter. But if you look at the quarterly subscriber numbers, only adding 2 million is definitely a disappointment. Last quarter, they added more than 12. What's your reaction?
Right. Well, I agree. They should be managing for the long term, and streaming is probably a long-term proposition. Nevertheless, what I'd like to hear him comment on are some of these trends which are not looking so good. I mean, one of the things that's so important about this earnings result, I think, is it's a window into what the post-pandemic Disney is going to look like. And there were very few companies more impacted by the pandemic than Disney, given the nature of its business. And at the same time, it was pivoting into the streaming world, and it had a new CEO when all of this hit. Talk about a perfect storm. I give Chapek credit for, keeping things steady there. But there's the disappointing subscriber growth, which is perhaps beginning to suggest that in a post-pandemic world, people don't want to stay at home as much and watch streaming on TV. And I think that has been a big question among a lot of people. I'd like to hear him comment. Are they seeing churn? Are they seeing subscribers dropping out at all? Is it proving more difficult to replace them? I think that's a very important number. Also in these results is the decline in the revenue per subscriber number. And that at some point has to move in the other direction as well. They're only getting a little over $4 per subscriber. That's not a very big number. And then finally, you've got the cost number. I mean, it's disappointing, I think, to see that the loss at Disney Plus went up this quarter. You would expect it to be narrowing, not necessarily making money yet, but you'd like to see a trend of that going down, but it went up. So why is the loss going up? And there has been a lot of investor anxiety about the whole cost structure of the streaming industry. I mean, talent is lapping it up. But, what it's costing for directors, for producers, for content. There's a bidding war out there, and it's making it very expensive to fill these streaming platforms.
Jim, should they embrace sports and ESPN or chop it off, as some have sort of floated out there as a conversation point?
Well, everybody got so dazzled by Disney Plus that they stopped looking at ESPN, which is a mistake in my view, because it is a cash cow. It still generates a lot of revenue and profit. It's a big moneymaker for them, but it's locked in the old cable model. They didn't provide specific ESPN results. They did say it contributed to the weak linear programming, which they call the broadcasting cable networks. Again, they benefited a little bit in the pandemic because the sports programming went away. They didn't have to pay for it. But now they're getting hit by the ever-rising cost of sports programming. And again, there are a lot of other competitors bidding up these properties, even as the cable model is deteriorating. So I would like to hear more. They're going to have to come up with a plan for ESPN at some point. If they just stick to the old cable model, it's going to slowly wither, and they're going to lose out to direct streaming competition.